you guys being in the space as well, there's a lot of conversation about what was happening with interest rates. So Tiff Macklin was saying that, if you're a business owner or if you're an investor, rest assured that interest rates are going to remain fairly low for a very long time. And those are words for a very long time. So
hey everyone, we have Saman Habibi on the show today. Really excited to have a conversation with somebody who is a boots on the ground realtor right here in the Greater Toronto area. And one of the reasons we wanted to open up this conversation was just to kind of have a real conversation and discuss real things happening in our market today. So by the time this episode goes out, we're probably going to be close to the end of 2022. And, it has definitely been an interesting second quarter of the year. And so I'll tell you a little bit about Saman. He is sorry?
Second half.
Yeah.
Uh-huh.
Yes.
Second half. He is an agent with Right at Home Realty, practices primarily in the Durham region. He is also an investor. He's done a whole bunch of duplex conversions, is versed with the multifamily space, and definitely versed with investment focused real estate. So helping a lot of investors acquire and sell real estate. And I'm sure that he has lots of insight about what his clients have been facing and just what the market is doing in general, especially over the last little while. And, I think that that's sort of the golden ticket everyone's looking for, is for someone to tell them, hey, what's going on and what is, what are the next moves and how do we plan for 2023 really? Because I think a lot of people are just paralyzed because either they've been through some hardship or they've seen people go through hardship. So we really just want to have a conversation about all of that and really what, I know no one has a crystal ball, but maybe we can talk a little bit about what the indications are in the market and what we think is going to be coming. So I will let Saman tell you a little bit more about himself, his story, how he got started, all of that good stuff. So anyway, without further ado, thanks, Saman, for being on the show.
Thank you, Jose and Khadija, for having me. I appreciate it. Thank you for the introduction. As you mentioned, I am a full-time realtor. But going back a little bit, I started my career in accounting. I got my CPA and CA designation and worked at one of the biggest accounting firms in Canada for some time, for 4 years. And in that world, I got to really learn a lot about audit assurance and essentially knowing how to identify risk, whether it's for our own company or for an outside company, how to audit that risk, how to determine if they have a good plan in place to mitigate that risk. And then essentially just really look at financial statements and audit financial statements and provide an opinion on it, which I think, really transfers into real estate because we did that, for clients on an annual basis. But in real estate, I get to do that on every deal, essentially figure out if there's any risk, relay that message to our clients, and then really come up with a plan as to how we're going to identify the risk, what the time horizon is for the project, for the investor. So that skill has really transferred and helped me have confidence in myself and in the value that I provide to my clients. But I think it also gives some comfort to my clients knowing that they have someone competent on their side, working, especially when you're up against, 60, 70,000 other realtors. It's good to have an edge on top of them. And then after that, I went into industry and worked at Magna International and did a lot of financial planning and analysis, and essentially, worked on budgeting, financial statements, forecasting. And I think that again transfers over to real estate because now I get to do that with every single project that I present to my investor clients and really get to build them a model as to what that model is going to look like today, tomorrow, and especially in this market when rates are a bit higher and there's a bit more risk on the table. But otherwise, I've been able to in the real estate world come in, really help investors, whether it's beginner investors or novice or very experienced investors. So worked on single family deals, worked on duplex conversions, worked on multifamily deals and land assembly deals. And and that land assembly turned into a project now where the developer has approved plans to build, I think, around 300 or so units on it here in Whitby. So a lot of experience and boots on the ground experience here, but yeah, nevertheless, it's never a dull moment in the real estate world.
For sure. And I wanted to know what got you into real estate. Like, was there Was there a moment where, hey, I'm gonna start investing in real estate?
I mean, if I go back to the very roots of how this all started for me, the term real estate I find is a very loose term, especially when we talk with, beginner investors. Real estate can be buying a pre-construction investment property. It could be going into real estate and acting as a realtor. It could be, going into the more advanced stuff. So for me, real estate really started, that idea really came to me by my father. So when I was graduating university, looking back at it now, I remember them looking at making a purchase. And I think he was the first one to kind of introduce real estate to me. And his introduction was, go get your real estate license. We're maybe going to buy one or two properties and you may be able to get a good commission out of it. So that was the initial introduction to real estate. But I think, coming from an immigrant family, and going back to where we came from, which is Iran, that economy is not as diverse as it is here in North America, right? So in Iran, it's very much hard asset. It's real estate is pretty much like, the way you go or the way you used to go, and which is what my family is used to. So I think that knowledge was strong with my parents, and that's an asset that they really understood, and it was easy to explain to me. So I'd say that was my first introduction to real estate. And then once I got into real estate, it was at my brokerage, really finding a mentor who was specializing in this space, in the investment space. And that really started with me going out to property workshops that he was hosting. Went there, really got to see the bungalows, got to see, what this whole conversion thing's about, got to really dive into the numbers, understand the refinance process, and really see that there's an opportunity here to go into an asset and have control over the lift versus, going into the stock market where you really don't have any control over the lift. So bit of a long answer, but that was my initial introduction to real estate.
Oh, no, nice.
Yeah.
And so tell us a little bit about your your current portfolio and what that looks like. I know you mentioned earlier you have a lot of duplex conversion experience. Maybe walk us through that.
Yeah, sure. So on my own, I've done around 5 or 6, 6 conversions, sold 3, kept 3 in the portfolio. The reason for the sales was essentially to have capital at hand and to be able to go into properties with better development opportunities. So the properties that I hold right now sit on bigger lots, so they give me the opportunity to do additional building on it, and they have better zoning opportunities on them as well. So the one thing that I've noticed is that as prices start to increase, you need to have the option to do something with the land, right? And for me right now, on the single family building lot that we own, the next biggest opportunity or the next highest and best use is going to be either the garden suite or some sort of third or fourth dwelling. So the properties that we decided to keep were properties with I'd say 50 minimum frontage and 120, 130 depth. So that's what I've kept to myself. But in terms of and of course, a couple flips in between to also be able to raise a bit more money and have things in house. But besides that, the duplex conversion experience has been interesting because it's been a very simple asset for investors to get into, and a lot of investors are interested in this. So in 2021, I think we helped somewhere around 21 or 22 investors kind of do this, and came to a point where it was a very risk-free investment to make, right? So we knew what we were getting. We knew what the ARVs were going to be at the end of the year, at the end of the project, due to the high comparables that we were seeing in the market. And the process was essentially, down to a very simple process to follow. I have a Rolodex of people that I use and in the order that I use, and essentially any clients of mine who purchase with me, I essentially hand this Rolodex over to them and I say, here it is. You decide who you want to call. Each trade, there's maybe 2 or 3 of each trade on that Rolodex, and these are people that I work with. So I give that Rolodex to them and kind of give them the freedom to learn and kind of experiment. But in terms of what I do, like the one thing that I always do with every single client is make sure that I'm there for the planning process. So the planning process where we have to decide the design of the lower unit, and that design essentially goes to the city. So I want to make sure that I'm there to essentially reduce any risk that there may be in terms of what we're building. So I want to make sure that my clients are going to build something that's going to achieve a great comparable for them at the point of refinance. And that typically comes down to number of bedrooms and bathrooms. I want to make sure I'm there so I can kind of visualize what kind of square footage we have and how we can best utilize that space.
Yeah, no, that's awesome. So, yeah, you talked about, like a heavy purchasing year in 2021. And I think 2021 and early 2022 were, kind of the peak of what we have experienced over the last decade. Talk to us a little bit about, what has happened since and what investors are facing in the market, smaller investors, especially who have purchased single families or perhaps purchased at the peak. Or perhaps tell us, maybe how the duplex model was able to sort of shield them from that. I'm just interested in your insights about, what investors have gone through over the last sort of year.
Yeah, I mean, I've always, when I spoke to my investor clients, I always spoke about real estate being impacted by, 2 or 3 things, right? It's typically the income levels that investors can bring to the table. It's the interest rates that are available in the market, and it's the supply and demand. So every time I spoke to my investors about, whether this is going to be a good investment or not, or trying to foreshadow the future, we always spoke about those 3 things. We said, what's happening with incomes, what's happening with employment, what's happening with interest rates, and what's happening with supply and demand. And, from my circle of friends and investors that we had, that income side always remained to be strong. I tend to attract investors who work downtown, work in the finance world, or from an engineering background, in the tech space. And, every time I spoke to these people, everyone had good jobs. So, for us, that income aspect was always great. People had jobs. People that I knew and my clients knew in their circle of people were getting promoted. We were talking about how much money they were making, and that narrative that we saw was very different from what was being projected in the media. In the media, there was a lot of there's a lot of low-paying jobs, and I was like, yes, I understand there's a lot of low-paying jobs, and we see that probably at the retail level, but at the corporate level, we weren't really seeing that. So that income component always seemed to be strong. In terms of interest rates, you guys being in the space as well, there's a lot of conversation about what was happening with interest rates. So Tiff Macklin was saying that, if you're a business owner or if you're an investor, rest assured that interest rates are going to remain fairly low for a very long time. And those are words, for a very long time. So we had a bit of comfort over interest rates as well. However, we did stress test properties. So when interest rates were around, 0.99, I think it was HSBC that was offering it at one point, or even 1.19, something like that. We were stress testing at around 3%, and numbers were fine. There's no really risk there. So income was okay, interest rates were okay, and the supply and demand. We knew that the supply was very low and we knew that the demand was very high. So when we kind of stepped back and said, what can happen here? I said, there's 3 things that can impact real estate prices. The one thing that we don't have control over is interest rates, and the communication that we're getting is that interest rates are going to remain low. So in terms of kind of identifying what we're going to do, and if that strategy is going to work, it seemed like it was good. It was a good opportunity to purchase. And I'd say 90% of my clients were able to purchase, refinance mid to late 2021 and even early 2022. And the saving grace was that there was huge appreciation in the Durham market. There was around 25 to 30% appreciation across the board from Pickering all the way to Clarington. So a lot of investors were able to pull some money out. And of course, there are some investors that are still not done the project, and they're waiting to see what's going to happen with their refinance process. But, has the refinance process been impacted? Yeah, of course it's been impacted, across the board, right? It's not even just real estate. It's everywhere. You talk about every single asset class, from real estate to the financial markets, to crypto, everything's kind of taking a beating right now. So, it's hard to kind of, point fingers at one thing, but I would say, from that duplex conversion strategy, is that strategy still alive? I'm telling my investors right now that, there's really no point in doing a full conversion right now, because the spread between a turnkey property versus an as-is property is just not large enough. And two, the biggest risk right now is the refinance risk. So if you can mitigate that risk and one, deploy less capital upfront and have a turnkey property and not have to worry about a refinance, there's really no point in stressing over a construction project, having to, come up with plans for materials, for labor, and so on. So our focus here has shifted a little bit. We're really guiding people towards buying just turnkey properties, simply due to the fact that there's a bit more risk right now, and the best way to mitigate it is not to really have to deal with those risks.
Yeah. Actually, that was going to be my next question, which you just answered.
Yeah.
So you're still advising them to buy right now, because obviously you're getting great deals, you're able to negotiate great prices, and buying turnkey. Are you seeing, the supply there for turnkey duplexes, and what type of pricing are you looking at currently?
Yeah. So initially, around March, April, May, we weren't really advising people to buy. There was just too much risk, and I run a very tight shift with my business. Hold a good reputation. Very confident in saying that there's maybe one investment that's been purchased at the peak of the market. Besides that, have never taken a push strategy. Have never sold pre-construction. I just don't believe in it. I'm not going to push it. So the strategy was not aggressive to begin. And I think it really worked in our favor, because the longer people waited, the more prices came down. So, from peak February 2022 till now, we're down around 27-28%. And, we were kind of looking at the Durham market and what was happening. And we were seeing a lot of property tours happening. And me and my business partner, we were just wondering, are we doing something wrong here? Are we being too safe over here with not doing property tours, with not really pushing properties to our investors? And we're comfortable saying that we did the right thing in not pushing properties from February until essentially now. But the trend that we've noticed since July of 2022 is that prices have plateaued, or in fact starting to increase slightly. And by slightly, I mean maybe 1 or 2% month over month. But essentially, prices have plateaued mainly due to low inventory levels. So in the Durham region, we currently hold the lowest months of inventory in the GTA, which means that prices are going to remain stable for the foreseeable future. In terms of, to your second part of your question, in terms of where our numbers at now, just to give you a perspective, at peak of the market, a turnkey duplex was around 1.1 to 1.250. And those are just based on comparables that I've seen in the market. Now that number is down to 8 to 850. So you can buy a turnkey for 850. And in this market, sometimes it's even hard to sell for 800, 850. I had an off-market property that was legalized in 21 in Oshawa in the McLaughlin neighborhood on a 58 by 135 foot lot. And we were offering it at 800K, and we were still having a hard time selling the property. And I think mainly due to the fact that, again, I think it goes back to, talking about your clientele. These people are smart. They're reading the news. Most of them are invested in the financial markets. They can cut through the BS and see that, there's perhaps going to be another interest rate hike, coming up this week. And, it's winter months. There's really no need to rush into the market, and people are still waiting. And, I can't blame them, because it's worked fairly well in the last, 6 to 7 months. So, yeah, I mean, it's to give you an understanding of the number, from 1.1 to 1.2 down to 830. And it's still sometimes hard to convince people to buy, because they still think that there's more blood on the streets.
For sure. No, and it's such a substantial drop too. I mean, granted, I know the comparables as well. I sold a property, one of our projects as well at the peak, and glad I did.
Yes.
And, now I see it's a it's a huge drop, especially for the duplexes. So yeah, very interesting. What's going on?
Yeah, I mean, the other interesting point is that, at $1 million or $1,000,001 at 1.1% versus at 840 at 5%. What I'm trying to convey to people, and the comforting point right now, is that from a payment perspective, you're fairly equal. Like your payments at $1,000,001 versus today at interest rates are fairly stable. Like they're pretty much the same. The benefit with right now is, of course, you need less capital up front because your purchase price is lower. You have a smaller principal to pay off. Of course, you have the advantages of a buyer in this market, right? You can be very conservative with your offers. You can be very conservative with your clauses. You can be conservative with your closing dates. Although I don't recommend people to have very long closing dates because comparables can really, ruin it for you from a financing perspective. So I would say the saving grace right now is the smaller capital needed to get into the market. Yes, there's been a big correction in prices, but rental rates have not corrected as much. So rental rates have come down slightly, but it's still very good in terms of what you can get. So on a bungalow, you're at least around $4,000 a month, and maybe even $4,300 a month plus utilities and hydro.
Right. I'm curious to know as to, from the lending perspective, like from all the deals that you recently done, has the banks, lenders been giving a little bit harder time to qualify?
Appraisals.
Appraisals. Like what kind of issues are you seeing from that perspective?
Yeah, from an income verification perspective, it's definitely changed. They're doing reference checks, they're calling employers. And I've heard that they even have their own guidance on the type of jobs and the risk associated with that job. So, being in tech, being in the tech industry, working for a global giant may seem like a good career to have, and I'm sure it is, but there's obviously a bit more risk in that. Of course, with all the layoffs that we've seen in the tech space. So they have their own guidance on who you work for and what kind of risk that brings to the table. And besides that, in terms of appraisals, I've heard that, they like to do, if a closing is more than 30 days apart, if they're doing an appraisal today and the closing is, let's say, 60 days from now, they might even want to do an appraisal 2 weeks before the closing date to make sure that the value hasn't dropped materially. Have I seen that? Have I seen appraisals coming in a lot lower? Not really, because from my experience and my advice to my clients has been, we need to close within 30 days or so, because otherwise there's just too much risk. And, if you're in the market to buy, technically you should be ready to go. Your cash should be in your bank account and not in the markets. And you should be already qualified to purchase. So I'm not really dealing with anyone with more than 30-day closes, but I know that is a risk. And besides that, any additional risk? No, I would say those are fair numbers. Yeah.
Are you seeing like loan to value coming, changing at all?
On purchases happening now,
especially on like investment properties.
Yeah, I mean, people who own, definitely loan to values are changing a lot. For people who are purchasing right now and closing, the loan to values aren't changing it that much. It's, on an investment property, it's still 80% loan to value. But on, people's current portfolios, I think those have taken a beating. It's, people who were at 60, 70% are now perhaps back to 80% or maybe even. And I mean, if you've purchased in the first half of the year, you're probably in a bad spot right now. But the message that I've been kind of trying to get across to our current investors is that if you're on a variable, okay, let's figure out what your payments are, and it's kind of matter of surviving the next couple of months until rates stabilize a little bit. But besides that, let's kind of let's stress test your property at what it could be, what your numbers are going to look like at 3-4%, because I believe that that's where long-term we're going to be. And I would say, if you're comfortable with those returns, then I'm advising people to keep it. But if people are not comfortable with those returns and, they're thinking that this is not what we got into, then there needs to be have a conversation on whether you need to keep this property or sell this property.
Yeah, for sure.
Yeah.
So in terms of, I mean, I know no one has a crystal ball, but where do we see that, if you were just to predict based on what you're seeing? I know everybody's waiting for this moment when they can start pivoting. And, it's funny. I don't, everyone has a different perspective, but a few people I've talked to feel that it's not going to be a rapid pivot. It's going to be sort of a slow, like almost stabilization. And then it's going to be a stabilization. And then we're going to slowly maybe see some increases. Right. And a lot of it has to do with economics and interest rates and all of that good stuff. But in your opinion, do you think the worst is done? And do you think that we're kind of getting into an environment in 2023 where investors should be prepared to start pulling the trigger again? I mean, I don't think there's such a thing. I personally think that, you, like you said, you're in it for the long haul. And as long as the deal makes sense, and you stress test it and you underwrite it properly, like it just depends on the deal. But I know there's a lot of investors out there who are waiting for some sort of, signal that, okay, now it's time and the market has definitely like hit its bottom and now it's going to go up again. And like, we should start making some moves.
Yeah, I think in Canada and in the last 10 years, we've been very privileged with rates and real estate for that matter.
Sure.
We've always been conditioned to believe that interest rates are going to remain low or are going to come down. And we've been conditioned to believe that real estate asset prices always increase over time. And it's worked out very well for a lot of people, right? But I think that there needs to be a bit of a reality check in terms of what the future holds. In terms of, do I think that the worst has passed? I mean, it's hard to believe that we're going to have a more aggressive than increase, to what we've already experienced, right? From the peak of Feb till now, I think, we've seen the fastest interest rate growth at, 350 basis points in over 6 months or so, which is very aggressive. So, do I think that we're in for another 6 months of that? I don't think so. I don't think that could be in the plans, because if it was, now we're talking about interest rates going back to, to the 80s where it was at 10%, 12%. It's very hard to imagine that, considering the communication that was provided by the Bank of Canada, and the ability for the banks to allow people to take on mortgages at a very aggressive rate. So, there's also a lot of risk for the banks as well. So if those rates go up, the bank's not in the market of taking on real estate and selling a depreciating real estate. They just want to be able to recoup their interest expense. So, do I think that the worst has passed? I like to think so. Do I think there's more interest rates coming? I think, yes, there is a bit more hikes to come. And what's the indicator of that? I think I would say the indicator of that would be, the global economy and what's happening with the global economy. We look at all the turmoil around the world. It's not very easy. I think we've really got to see how much of an impact COVID can have, the war in Europe can have in terms of supply chain and what that means to the end user and what that means to inflation. It's very, evident that it's had a huge impact. And I don't think people realize that it would impact us this much and this far away from Europe. So, there's a lot of risk there. So that's kind of talking about it on a global perspective. And that's just issues that we're aware of, right? And then when we kind of look at Canada and when we look at supply and demand here, the discussion in Canada has always been that, well, demand is high and supply is very short. So that's going to allow real estate prices to stay very stable. And I would say it's true. I would say that, we know that demand is high and immigration is coming in fast. And to that, I would say that when we talk about supply and demand, the demand is very imminent. It's now. We want real estate now. Immigrants are coming now. They need to place state now. People are invested and they need the market to change now. Whereas supply, it's always been, we've been talking about the supply issue for the last 10, 15 years, and there's always been red tape. And now slowly we're starting to see that supply factor kind of change, right? We saw that Bill 23 come into effect in Ontario, where they're going to release Greenbelt and they need these owners of these lands to essentially have a plan to build real estate. So even if those people do that, the plan to bring in the supply is going to take at least 5 years or so. So I like to say that, yes, I still believe, and I still do believe in real estate as an asset to hold, but I just think that the mentality has to change. We need to get away from being comfortable with consistently refinancing properties to lever up and buy more properties. And I think we need to come to realization to where the interest rates are going to be. So I would say if you're able to run your numbers at conservative numbers, and the number I've been using is 3.75 as a stabilized market. And I'm kind of doing that when I'm looking at interest rates being around 3 to 4% and being on the higher end. I'm going with 3.75. That's my logic. I could be right, I could be wrong, but I would say if you're, run your numbers at a bit more of a realistic figure, but not very low. I don't think we're going back to, the 1% anytime soon. If you're comfortable with that and you're comfortable with that ROI, I believe that yes, we are in the market to purchase. And the other thing I would say is that your purchases need to be very strategic now. So, and for me, when we're talking about just, the simple residential purchase that's going to be either a duplex or so, I believe that the value on land is definitely worth more now than it was in previous years. So, I'm not really interested in buying that lot that is 38 by, 100 feet. I want bigger. I want to have the ability to do something, whether it be a garden suite, or something else that's in the pipelines. I'm not sure. So I think that the purchase has to change and the mentality has to be, the days of getting 20% ROI on a single family house may be done. So coming back to reality is my understanding of this. Yeah.
For sure. Well said. Well said. Yeah. And I definitely agree with what you're saying. I think, those low rates are never going to, I don't see it coming back for a very long time. At least another 10 years.
You know what? I say which is okay because it doesn't, that allowed people the low rates really allowed some people who were investing in real estate, who shouldn't be investing in real estate, right? Like you had a lot of literally everyone, real estate was the topic of conversation everywhere you went. A lot of people, pulled money out and bought pre-construction projects. And newsflash for you, those pre-construction projects in 2018 didn't make sense with, 1% interest rates. You were running negative then, and you're even running a higher negative now. So, the market was just way too easy for people to get into, and perhaps this is going to, make our real estate economy a bit more stable and safer.
Yeah,
100%.
yeah, I agree, and yeah, those pre-construction investment buyers are going to be in for a kind of a rude awakening. I don't know how they're gonna able to qualify and make the numbers work, or it's gonna be a very, very low leverage. I mean, even if you look at distressed properties for sale, there is a ton of distressed assignment sales coming to market, and they're either at purchase price or slightly above purchase price. And when you kind of figure out the HST implications on assignment sales now, which is a new thing as well, people are running at losses right away. Anyways, I don't know how these people are still selling and buying pre-construction, but I would say that that's an area where, if you believe that that's something you need to purchase, perhaps get independent advice from someone else that's not in the pre-construction business. Yeah, absolutely.
Yeah, absolutely. Yeah, definitely the days of speculative investment are coming to a close. And I think that which
is a good thing,
it is a good thing. I mean, they were causing havoc in the market too, in their own ways, right? There was, like you said, everybody and their mother was becoming a real estate investor, and making decisions that were solely based on expectations of appreciation. That the rent doesn't even cover the payments when they bought it. Forget now with new interest rates, right? Especially with the high prices, and now with the change in environment, like a lot of people have made some pretty devastating mistakes. But
I would say the other benefit that this market's going to have to some people, I would say perhaps to a bit more of the savvy investors, is going to be a bit of the tax advantages of, I don't know if tax advantages is the right word to use, but, the tax benefits you get from losses in capital assets. So, people running on negative cash flows, you're going to have the ability to kind of carry forward those losses for a few years, and even people having non-capital losses. So, let's say you have a flip that's gone completely bad and you're taking a $50,000 to $100,000 bath on it. if you're consistently in a position where you're owing a tax balance at the end of the year, you have a bit of a shelter there where you're going to be able to write off these your owing balances. But again, we're not in the business of taking losses and trying to offset it. Maybe if you have a large enough portfolio, but I feel like the average consumer in the market right now is just going after profits, right? They're not trying to shelter losses here.
For
Yeah,
sure,
absolutely.
for sure.
Yeah.
So, Saman, wanted to switch the conversation a little bit and tell us what drives you. I know you got a young family.
Yes.
Tell us a little bit about that and just kind of that experience of being a father.
Yeah.
And maybe talk to us a little bit about what you anticipate for yourself in 2023 coming.
Yeah, absolutely. Yeah, I mean, new father. My son was born January 2nd, 2022, and it's been a blessing for us, but it's also been very difficult. I was led to believe that it's very easy to kind of tell what's going on. They're either hungry or they need a change, and that's it, right? But it's I mean, you guys have 3 kids yourself, but it's been very challenging for us. And, for myself and for my wife, we're both self-employed. We're both entrepreneurs. And, for my wife, more than anything, I got to give her kudos because she's been able to, really look after our son and kind of be guidance there. And of course, as mothers are, and also been able to run her business and, grow her business at a very fast rate during all this. Right. So I've been very blessed to be in an environment where we can both thrive, especially in an economy where it's going downhill. We've seemed to rise. So that's been very, comforting for the both of us. And it's given us a lot of confidence in ourselves. So that's been phenomenal. And then, in terms of what drives me, of course, I would say it's definitely my family, whether it be my immediate family or my extended family, my parents, my in-laws, but also, the ability to really see, right. I've got to have a career change. It's a funny story. So when I was at Magna, I was part of the budgeting process. I really got to see, and I got to budget what our leadership was going to be earning in the foreseeable future. So, I was able to see what the VP was bringing in. I was able to see what the director of finance and the whole finance team was about to bring in. And at the time, those numbers seemed very, very lucrative, right? I was like, I would love to get to that level. And I was kind of doing the math in my head and kind of thinking, how much time have these guys invested in the organization? What kind of seniority do they have? What type of time frame is it going to take me to get there to that level to have these kind of earnings? And sure enough, you look at it and you're like, damn, there's a lot of time that needs to be invested. And that's assuming that the politics of it all also works out as well.
Yeah. Sure.
And then, making that career change and coming into real estate, my first 6 months were rough, right? I maybe worked on 2 or 3 deals. And I think 2 of those were leases. So nothing amazing by any means. And then, I got to have my one full year in real estate. And in that year, I got to do 19 deals, which was amazing. And I got to really, see the fruits of my labor. Got to see the money come in, and it was very nice, and we were very happy with it. The following year, I got to do 24 deals, and I'm kind of sitting there saying, I was in a position where I was making $90K a year, working this accounting job, stressful hours, stressful month ends, quarter ends, year ends, audits, making $90K a year, and then you come into real estate, you work for yourself, and you kind of see what kind of money you can pull in, the freedom you have to invest, and you guys have seen, when you hit a home run deal, how that feels, and being able to hit a few of those, just based on the freedom of time and freedom of choice that I had, it was amazing. And, really get to see your life change, kind of gives you a glimpse of what you can achieve. And, now looking back at the numbers that I was seeing at Magna and wondering if I can, hit those numbers at any point, and being able to hit them fairly early in my career, it feels great. So kind of seeing, the fruits of your labor for myself and for my wife, and seeing how that kind of changes our life, has definitely given us confidence to keep going. And that's a drive for me for sure. But besides that, also seeing, the happiness that, I'm able to bring to my client's face, whether it be on the transaction and on the buy and sale of their own home or on their investment property. So yeah, that's been the drive for us. And more than anything, again, I think it goes back to the freedom of time. If I was at my old job right now, this would be a very busy time. Whereas now I get to watch the World Cup at any day and time that I want, and have the freedom to go to work when I want or stay home when I want.
Yeah,
absolutely. No, that's a really good answer. Yeah, I think comes to life even more when you have children. So definitely you appreciate every moment, because there's not a lot of moments, it feels like. So the days go by so fast. And, for us too, like, I just cannot even imagine what it would feel like to have to juggle commuting and schedules and going into work every day and having to be, reporting and it would just be wild. So I think all of us who are on our own are very grateful for that very same thing. So, so Saman, if people want to get in touch with you, we'll put it in our show notes as well. I think you have a pretty cool Instagram page.
Thank you.
Where people can follow you. What's the handle for it?
Yeah, absolutely. So on Instagram, it's Saman Habibi _real estate. I also have a YouTube channel where I try and focus very much on the Durham region and Oshawa in specific, and that's Saman Habibi _RE. And I'm also active on Twitter, where I like to post data related to the market with what I'm seeing. And it's the same handle, Saman Habibi _RE on Twitter as well.
Okay, fantastic. Perfect. We'll link it all. If anybody wants to reach out, I'm sure they can find you on Instagram or on YouTube, send you a message. If you guys are interested in the Durham region, highly recommend you reach out to Saman. If you just want to have a chat, I'm sure, just on the market and, when he thinks, what's going to happen in the next few months. I definitely think that real estate, like they say, the money is made in buying real estate and waiting. So I still am not a proponent of timing the market. I think that, great deals are not found, they're created, right? So we got to focus now on creating those great deals, working with people who can help us and guide us create those deals. And, still confident that it's the best asset class out there.
Yeah, I agree. And, if I can make one thing clear is that, there's no blanket answer for anyone. To Khadijah's point, it's all very directed towards each individual person and their time horizon of hold and risk. So I would say, to your point, Khadijah, it's not about timing the market. It's about making a purchase that you're comfortable with, that makes sense in your portfolio, whether it's today or whether it's 5-10 years down the line.
Yeah, absolutely. Yeah. So thanks again, Saman. Thanks for your time and the conversation.
Thanks so much for being on our show.
Thank you guys. Appreciate it. Pleasure being here. And thanks for having me on the show.